What if I told you there's a financial weapon of mass destruction hiding in plain sight? A market so vast, so interconnected, and so poorly understood, it could turn a sharp shock into a global collapse overnight. This isn't conspiracy, it's derivatives. And the headline number people whisper about isn't a typo. Estimates of notional contracts stretch into the hundreds of trillions. And when you include off-balance sheet and structured instruments, some analysts say the tally approaches $1 quadrillion. That's a 1 followed by 15 zeros. To put that in perspective, it's many times larger than global GDP. Let's be blunt. Derivatives are powerful tools used legitimately to hedge risk, lock in rates, or transfer exposures. But they're also synthetic, leverage-friendly, and exquisitely interwoven between banks, hedge funds, insurers, pension funds, and sovereigns. As Warren Buffett warned years ago, some derivatives behave like financial weapons of mass destruction. He wasn't being melodramatic, he was naming the hazard. If you already feel uneasy, good. That nervousness is the rational response to a web of contracts where notional figures vastly overstate cash at risk. But they also hide the complexity. Notional is the base used to calculate payments. It's not the same as the market value or the credit exposure, but neither does that comfort you when counterparties fail and margin calls cascade. Official trackers like the Bank for International Settlements put global OTC derivatives notional in the many hundreds of trillions, with interest rate derivatives alone making up the lion's share. Other industry trackers show the numbers moving quarter to quarter, tens of trillions of exposure concentrated at a handful of large banks. These are not small, isolated bets. They are the plumbing of modern finance. To make this concrete, large banks report notional derivative positions in the tens of trillions each, and U.S. bank reporting shows the banking sector alone held over $200 trillion notional at points in recent quarters. That concentration matters because a shock in one big player doesn't stay local. Counterparties, clearinghouses, margin lenders, and insurers are tied to the same web. When one giant needs cash, the scramble can turn orderly markets into a fire sale in hours. So how does that turn into catastrophe? Think of the system as a massive spider web. Each thread is a contract, a collateral pledge, a credit line. Now imagine instead of silk, those threads are made of engineered cables, synthetic exposures, that multiply interconnections. A break in one place doesn't just make a hole, it transfers stress elsewhere, sometimes amplifying losses through netting rules, margin mechanics, and currency mismatches. When these synthetic strings snap, the whole web can shudder. The rest of this narrative walks you through the first 5 levels of contagion, the initial, rapid-fire sequence that turns a localized shock into systemic danger. Level 1. The shock, the black swan trigger. Every catastrophe begins with a trigger, a black swan that markets didn't price in. It could be a sudden sovereign default, a major currency devaluation, a catastrophic cyber attack on payment infrastructure, or an abrupt policy move. Whatever the shock, it creates losses on derivative positions that were priced under different assumptions. Suddenly, institutions that were hedged find themselves underwater and see margin calls spike. Margin is cash that must be posted immediately. If a global clearinghouse or a large dealer issues a margin call of tens of billions, who has that cash on hand? Not many. That immediate liquidity squeeze is the first domino. Level 2. Fire sales, when liquidity becomes poison. Faced with urgent margin and collateral demands, institutions sell whatever is liquid: government bonds, corporate paper, even prime real estate securities. But when multiple players sell at once, price discovery breaks. Quality assets trade at distressed levels simply because the market cannot absorb the supply. That's a fire sale. Prices crater, and instruments that were supposed to be safe suddenly look toxic. Importantly, many derivative valuations depend on those same market prices, so the selling feeds back into losses, forcing more selling. The circle tightens. Level 3. Counterparty panic. Trust collapses. Derivatives live or die on counterparty trust. Parties agree to exchange cash flows because they expect the other to meet obligations. When a major dealer misses a payment or shows liquidity strain, its counterparties scramble to protect themselves. Banks reduce overnight lending, prime brokers call in leverage, and lines of credit tighten. Interbank markets seize up. Credit becomes scarce just when firms need it most. This is not hypothetical. Historical episodes show that in minutes the interbank market can freeze, amplifying the shock into a liquidity crisis. Level 4, Cascade Failure, the geometry of interconnection. Here's where the mathematics of networks becomes terrifying. Derivative contracts are not isolated bilateral bets. They are stitched into complex portfolios with offsets in other instruments. Bank A owes Bank B on one swap, while Bank B owes Bank C on another, and Bank C owes Bank A via a different structure. Failure in one node can create netting paradoxes and operational paralysis. Clearinghouses mitigate this risk by centralizing and netting positions, but not all contracts are centrally cleared. Credit derivatives and bespoke swaps often remain bilateral and opaque. When netting assumptions blow up or legal disputes delay settlement, the cascade moves from financial algebra to real-world insolvency. Level 5. The insurance and pension shock when protection fails. Insurance companies and pension funds buy derivatives or buy protection via credit default swaps and options, precisely to reduce risk. But those protections rely on the creditworthiness of the sellers. Remember AIG in 2008? AIG wrote massive CDS protection and then lacked the liquidity to honor margin calls when mortgage-linked losses surged, forcing a government rescue. That episode is a template. When insurers or large counterparties fail to meet obligations, institutional safeguards break, and pension plans and insurers that seemed conservative suddenly become vectors of systemic distress. The retirement savings of millions are not abstract numbers, they're livelihoods. When insurers default, the social consequences are immediate. At this point, you should be feeling the geometry of the risk. Shock, liquidity scramble, price collapse, counterparty distrust, cascade into insurers and pensions. Those are the first 5 levels, and they can unfold in weeks, days, or even hours in extreme scenarios. The technical literature and regulators keep a close eye on these pathways because they're not theoretical. We've seen versions of them before, but never at the present scale of interconnection and notional magnitude. Now let's anchor the scale with some cold numbers you'll want to remember. Official oversight bodies track notional amounts and gross market value separately. The BIS and ISDA reporting shows interest rate derivatives as the largest bucket of OTC notional outstanding, hundreds of trillions, while exchange-traded derivatives add another sizable layer. U.S. bank regulatory filings report bank derivatives notional in the low hundreds of trillions collectively, concentrated at a handful of global institutions. These numbers vary by reporting method, notional versus gross market value versus net credit exposure, but the takeaway is the same. The web is vast, concentrated, and active. If that sounds abstract, here's a visceral fact. JP Morgan, Goldman, Citigroup, and other large dealers disclose derivatives activity in their regulatory filings measured in trillions of dollars of notional. These positions are often hedges, but hedges that depend on counterparties, central counterparties, and liquid markets to unwind if necessary. There's no single monster contract. There's an ecosystem, a set of mutually reinforcing exposures that can magnify relatively small losses into systemic collapses. Practical survival moves for institutions and individuals: deleverage and simplify exposures. Complexity is danger. Institutional investors should reduce opaque bilateral over-the-counter bets and prefer centrally cleared instruments. Retail investors should avoid funds with large hidden derivatives bets. Diversify operational counterparties. Ask managers, who are your prime brokers, custodians, clearing members? Spread counterparty risk across jurisdictions. Hold real liquidity. Cash equivalents, short-dated government bills, and high-quality liquid assets give you time to avoid fire sale pricing. Liquidity, not headline returns, wins during panics. Stress test for counterparty failure. Scenario test. What if your prime broker is suspended? Can you access assets? Do cash lines exist? Prefer assets with intrinsic use or settlement value. Real assets, rental property, farmland, commodities, and carefully selected precious metals can help, but none are foolproof in acute liquidity squeezes. Think multi-jurisdictional. Legally compliant foreign holdings can diversify political and regulatory risk when domestic systems seize. Institutional reforms that reduce systemic risk. Push for real-time consolidated derivatives reporting to supervisors, not public panic data. Counter-cyclical margin buffers in good times. Stronger CCP default resources and clearer pre-funded loss allocation rules. Enforceable TLAC and resolution plans for dealers. And targeted position limits to avoid single dealer concentration. These measures don't remove tail risk but compress it into manageable channels. If this rattled you, do one concrete thing right now. Check your liquidity. Confirm you have 3 to 6 months of accessible cash, and verify where your investments are custodied. Want deeper briefings and real-world templates to shore up portfolios? Subscribe to Finance Facts and download our survival checklist. Stay informed, prepare, protect.